You are most welcome to ABACUS Business School. My name is CPA Nobert Turyamuhaki, and I will be taking you through a mock debrief for the December 2025 examination diet. In this mock debrief, we shall look at what are the examination techniques, what things must you understand before you go into the exam. The paper is called CPA 11, Taxation, and it is a paper which has two sections. First of all, it is on level 2 and it has two sections. It has section A and it has section B. Section A has question 1, and this question is compulsory. Compulsory means it is attempted by all students. And it has section B, which has 4 questions. So it has question 2 up to question 5. In these 4 questions, you are expected to choose 3. So it is 4, choose 3. Question 1 is compulsory, like I said, it takes 40 marks. And question 2 up to 5, it is 3 questions times 20 marks each, meaning that out of the 4, you choose only 3. So when you total these are 60 marks. These are 60 marks. So when you get 60 plus 40 marks, it totals to 100 marks. What you need to note for this paper, the pass mark is 50%. So pass mark is 50%. So for you to pass this exam, you must have scored 50%. The allocation may not matter, so you may decide to get 40 marks in question 1 and then 10 marks in section B, whichever works for you. Now, what is in each section? Question 1, like I said, question 1 is a number which has 40 marks, and the areas that are commonly examined here are mostly 2. One is taxation of business income. Business income. What most people call corporate tax. Now, here the examiner expects you to compute the chargeable income. Expects you to compute the chargeable income of companies and also the tax payable thereof. Then the other area where it can come from is taxation of partnerships. Taxation of partnerships. So the examiner may expect you to compute the chargeable income of a partnership and then the tax payable of the partnership. Now, we are going to look at the overview of taxation of business income. First, taxation of business income. Taxation of business income. Taxation of business income. What does it entail? Now, one, you need to note that taxation of business income is guided by the Income Tax Act. It's guided by the Income Tax Act. It is the one that highlights how to compute the chargeable income and what tax you are expected to pay, and all the guidelines that support you to compute this. One is that there are 2 perspectives you need to put into consideration. One is we have a taxman. Then 2, we have the accountant. So in normal business operations, the accountant prepares financial statements in accordance with international financial reporting standards. And he will use these standards to come up with majorly the income statement, or what we call the statement of profit or loss and other comprehensive income. So the accountant will come up with revenue, and he will less the cost of sales. He less the cost of sales. From cost of sales, he will get what we call the gross profit. Then from gross profit, he will add other incomes. He will add other incomes, and then he will get what we call gross incomes. This is in line with the International Financial Reporting Standard. Then you will less expenses. You less expense. So the expenses are always many for the business. So the expenses could include depreciation. It could include fines and penalties. Fines and penalties. It could include salaries and wages for staff. It could include things like electricity. It could include things like entertainment. Entertainment. So when these ones are removed from the gross income, the accountant gets what we call the profit before income tax. Now, this is where he gets profit before income tax. So the taxman, for him, he expects you to compute the tax. And for the accountant, the taxman is saying, when you are computing the tax, you do not actually, because the accountant will charge tax at 30% of PBIT. And he will say, this is the tax that we need to pay. But the taxman is not agreeing with him in accordance with the Income Tax Act, because the Income Tax Act spells out how tax is computed. So the taxman is saying you should start with PBIT, because some of the items that have been included in this PBIT, the taxman may not agree to them according to the tax laws. So you may find like revenue is revenue that has been added here. You may find some of it shouldn't have been included here. Cost of sales should not have been reduced, some of it. Or you may find that other incomes that have been included here are not incomes in accordance with the Income Tax Act. And then expenses that have been included here, some of them, the taxman does not recognize them as expenses. And as such, because those discrepancies exist, that's why there are two different ways of computing taxes between the accountant and the taxman. So PBIT, the taxman says we start computing taxes from PBIT. Now, he will allow some expenses and may not allow some expenses. So then he expects you to add back what we call non-allowables. So non-allowables, you can call them non-allowables, or you call them non-allowable deductions. So the non-allowable deductions may include items. Now, what is added here is incomes that were not considered by the accountant. So the taxman is working backwards from what the accountant already did, because when you are computing taxation, it is the examiner gives you the profit and loss, and it is from that he expects you to compute the tax payable. So you add incomes that were not considered. So these are the incomes that were earned by the organization, but the accountant had omitted it. You add it there. Now, you also add back the expenses that are not allowable. That are not allowable or not deductible. So you may find that some expenses the accountant added there added in here in the expenses, but these expenses are not deductible. Examples we have depreciation. Depreciation is an expense you incur, but it is not allowable for tax purposes. It is supposed to be computed in accordance with Section 27. But penalties and fines are not allowed deductions. Entertainment, staff parties are not allowed deductions. So those ones are added back. So that the expenses that have been considered by the accountant but are not allowable deductions. So here there may be many expenses here, many items, and then also many items here. So that is the general rule that we use. Then you less the allowable deductions. Allowable deductions. So under the allowable deductions, these are incomes that are not taxable. Incomes that are not taxable. So these are the incomes that the accountant considered as incomes and has included in PBIT. But according to the Income Tax Act, these ones should not be taxed. Examples of such incomes, we have rental income. So the examiner normally brings rental income. So we have rental income. We have incomes that are taxed as final tax. So we have interest income on treasury bills. So if you have interest on treasury bills, that is also not supposed to be taxed again. So you less it. And other incomes as specified in the Income Tax Act. Then we may have expenses that are allowable, or what we call the capital allowances. Capital allowances. So capital allowances, the examiner, the Income Tax Act gives you expenses that are allowable for tax purposes. But because the accountant, when he is preparing his financial statements, has not considered these expenses, because according to the International Financial Reporting Standards, these are not part of the expenses you include there. So examples, we have what we call IBD in this industrial building deduction. Now this one will have a working, and I will show you how you compute it. Then the next one is called the wear and tear. Wear and tear, some other people call it capital deduction. So this capital allowance, depreciation allowance, it is computed using a schedule. We shall also see how it is computed. Then others, we have startup costs. Startup costs, if you start a business, the cost of starting the business, within the first 4 years, they are allowable as deductions. Then others, we may have intangible assets. So the intangible assets, they allow you the amortization of this intangible asset as an expense, whereby you get the cost of the intangible asset, you divide by the useful life of this asset, and the cost, the amortization is allowed as allowable deduction. And after you get that, then you get what we call chargeable income. So when you add that, you get chargeable income. So when you get chargeable income, you may find that there are some losses that you carried forward in the previous period. So we call them assessed loss from the previous period. So this is when the business made losses in the previous year and did not pay taxes. So that assessed loss is subtracted from the chargeable income. Then after that, then you get what you call adjusted chargeable income. Adjusted chargeable income. So the adjusted chargeable income, it is from this that tax is charged. So you get tax payable. So tax payable would be 30% of this chargeable income times this chargeable income, and it is this tax that you are supposed to pay. But remember, along the way, you may have had what you call tax credits. So the tax credits, when you are conducting business, there are some taxes you pay along the way. So there's tax credits. So the tax credits, one of the tax credits is called the foreign tax credit. The foreign tax credit. So this is one of the low-hanging fruit, because this one is normally given in the exam. So once you have the template, you just need to come here and place it here. The assessed loss and these other tax credits are low-hanging fruits where you can easily pick the marks. So these ones you less. Now, the tax credit is if you are conducting business and then there is tax you paid outside the country as you are earning the income. Because when you are a resident individual or you are a resident person, you pay tax on worldwide income. So if there is income you sourced outside, you sourced outside Uganda, that one will the tax you paid in that country, it will be called foreign tax credit. Then you have what you call the withholding tax. Withholding tax. So withholding tax is the payments you received. Some of the suppliers you supplied may have withheld some tax from you. So that one is also removed. Then you may also find you have provisional tax. Provisional tax, as you conduct business, the taxman expects you to make two provisional taxes. The first provision, the second provision, and the final provision. I mean the final tax that you pay, which is now this computation you are making. So the first provision is made 6 months into the year of income, and then the second provision is made 12 months after the year of income, and then the final provision is 6 months after the year of income has ended. So if there is any tax you paid along the way, as provisional tax is also less from the tax to pay, and then you get what you call the final tax payable. You get the final tax payable. So this is how you compute the tax. So now you see it is different from what the accountant did. So using the International Financial Reporting Standards, we have seen that tax is based on PBIT. So you get the PBIT and then you charge your tax at 30%. But with the tax laws have a different way of computing tax, and this is what the examiner normally asks. They expect you to use a PBIT and you determine the tax. So what are the takeaways here? One is that once you reach an exam, you need to pick out what is the PBIT. So first of all, you enter an exam, you need to have a title, what we call a heading, the title of the question. So it could be ABC Limited, chargeable income, and tax payable for the year ended 30th June 2025. So after you have the title, then you come and do a template. So template is you have PBIT. After PBIT, you add back non-allowable deductions, and then you can leave at least 15 lines, and then you less allowable deductions. You leave about 7 lines, so that as you are getting more lines to add, you have enough space to add them. Then after that, you have chargeable income, and then this assessed loss is a low-hanging fruit. It is normally given in the question that does not need you to compute. Then you put it there, and then you have adjusted chargeable income and less tax credits. These ones are also normally given. They are also normally given. So you put them there, and then you determine the final tax payable. Now, from here, I need to take you through how you compute wear and tear, because we said one of the workings we shall have wear and tear. So that is one wear and tear schedule. That is one working. So the wear and tear schedule is a schedule which helps you to determine the depreciation allowance. So for you to have this, you have details, you have class. Now, the wear and tear schedule is given into 3 classes. So class 1, and class 1 is at 40%. Class 2 is at 30%. And class 3 is at 20%. Then you have the total. So, what does this mean? It means you need to place your assets. Now, this one is normally done for depreciable assets. For depreciable assets only. And it earns some marks. So as you are having your schedule of tax computation, you also have this wear and tear schedule, which also earns you some marks. Now, the depreciable assets are categorized into these 3 classes. And they are provided, the schedule is provided for in the Income Tax Act. But I'm going to give you a quick way of getting these assets. One is that we have assets in class 1. Assets in class 1 are only one type of assets. So for you to have this, first of all, you need to have the tax written down values, the balance brought down of the tax written down values. These are the values as of the first day of the year of income. And these ones are normally given in the question. So you list them here. Under each, the examiner normally gives you these tax written down values. Those are the values of the previous period. Then you add additions. So these are the assets that have been acquired during the year of income. You add those ones. Now, these ones, like I said, this is where now your judgment is required to say whether the asset is in class 1, class 2, class 3. Now, assets which are called data handling. It is called computers, and data handling equipment. So computers and data handling equipment are the only assets in class 1. So if if it is not a computer and it is not a data handling equipment, it cannot be in class 1. Those are the only assets in class 1. Now, the practice notes have added something which is in computers. If you have a software that is embedded with the laptop, that one will also be part of a data handling equipment. If it's a software for the laptop, if you, let's say you buy Windows or any other software which is integral to the functioning of the laptop, it will also be under class 1. But strictly, you include computers, desktop computers, and any other asset which is similar to the computer. Now, in class 2, you only add assets, equipments. You only put equipments used in manufacturing, mining, and farming. These ones are in class 2. So any asset any equipment that is not used in manufacturing, mining, and farming is not in class 2. So you only include these ones. Now, these are the only 2 classes that have specific kind of assets. So we said class 1 is computers and data handling equipment. Class 2 is equipment used in manufacturing, mining, and farming. Now, all other assets, any other asset is in class 3. Any other asset is in class 3. Now, students have always confused cameras. A camera is not a data handling equipment. So if you have a camera, it would be put in this other class. If you have fixtures and fittings, you have furniture, they would be put in this class. Then the other type of asset which is in this class is a motor vehicle. If you have a roads vehicle, the Income Tax Act gives it a maximum. If you have a roads vehicle of 260 million, you bought a Land Cruiser or a Mercedes-Benz for the MD, the only asset which is included in this class is only 60 million because it is capped at 60 million for class 3. Then the other balance of 200 million is considered as a business asset, and it will attract what you call the capital gains tax. So this is, then you total for each. After totaling for each, then you less disposals. If there is any disposal of an asset that has happened during the year, so you less it here for each class. You less it here for each class, and you will get the tax written down values. So it is on the tax written down values that you will slap the wear and tear. So here you will have the wear and tear using the percentages. So you multiply by 40% here, multiply by 30%, multiply by 20%, and this will be the total. So when you do the multiplications, it will give you the wear and tear, which is now the expense that is allowed for tax purposes. When you add these ones, you'll get what we call the wear and tear, which is allowed for tax purposes. Now, students normally stop here, but the examiner expects you to get the tax written down value carried down, which is the tax written down value of the following year, which is the tax written down value, which is the net assets, and less the wear and tear schedule, the wear and tear allowance that is given for each class. Then the answer you get is the tax written down value carried down. And these will be the values that will be used in the following year as opening balances of each class of assets. Then you get this total. This total here is taken to your template as wear and tear under capital allowances. So this template normally takes a lot of marks. So you need to focus on it and ensure that you are able to apply it. The other one is called the IBD. Now IBD is in full is called industrial building deduction. Industrial building deduction. Now this one, it is given to qualifying buildings, commercial buildings, commercial hotels, and it is charged at 5%. So for you, you need to have details of this. You have computation. This is the template I'm giving you. Computation and IBD. So what you have, let's say you have a commercial building. So you have a commercial building. So it is A times B times C over D. Now where A is the cost, the qualifying cost. What is the cost? So A is the rate, is the rate, which is 5%. So every year they give you 5% as industrial building, meaning that you are going to have this deduction for 20 years. Then B is the qualifying cost of the asset. qualifying cost of the asset. So the qualifying cost of the asset is how much did it cost to put this industrial building into place. And if there is any other expense that has been incurred and is capital in nature, during the year of income, it is added, it is considered as a new industrial building, and it is given IBD separately. If let's say you have a building and then you have an annex to it, so the building, or the building will attract its own IBD because it will have its own years, and then the annex will also have its own IBD. And then C will be the number of days the building has been first put into use for commercial purposes. Then D is the total number of days in a year of income, which is always 365 days. Now, C may be 365 days if it has been used for a full year of income, or it may be less depending on when the asset has been actually put to use. So then you get what you call IBD. So let's say the asset here, the commercial building, I'm going to have a hypothetical example. If the asset cost is 5 billion, so you have 5% times, let's say, 10 billion times 365 over 365. If I am using it for the whole year, then you will get the qualifying, you will get the IBD to claim. Now this IBD, it is the one that you use to put in, it is the one you use to put in your template for chargeable income. So these are the areas, the common things the examiner expects you. One, I said you need to understand the template for the computation of chargeable income and tax payable, where we said you have profit before income tax, you add back non-allowed deductions, and the non-allowed deductions are guided in the Income Tax Act, but we have given some of the examples. Then two, you less allowed deductions. So the allowed deductions, we have capital allowances, and then expenses that were omitted by the accountant but are allowable deductions. Then you have IBD under there, and then the wear and tear. So the wear and tear, we have this template that you need to master. So when you reach an exam, you need to have these templates. So the template will have class 1, class 2, class 3. Then to have additions, and then the disposals. Then after the disposals, you will have the tax written down value carried down, and then you get the wear and tear that you've computed and put it into the template. Then the next working that is commonly examined is IBD. IBD is industrial building deduction, and for you, you need to have a template whereby you have the commercial building and then the computation, which is A times B times C over D times that, you get the IBD. Now, if there are many assets that qualify for IBD, so you include them. This could be one, then you have another second one. You also compute the same, and you put in the template. So that's majorly how you compute business income, and that is the number for business income. And we have said it is compulsory and it takes 40 marks. Now, the second question is question 2 that they normally examine. It is called employment income. Employment income. So, employment income, every employer who employs individuals is required to pay tax for those, is required to withhold what you call pay as you earn and remit it to URA. Now, what that means is when they give you a contract of employment, they will expect you to pay tax. So the money they give, if you are earning 10 million, you will not take home 10 million. Some of it will be retained by the employer and will be remitted to URA by the 15th day of the following month. So the examiner also tests this, and it is part of the syllabus that is expected of you as a CPA Level 2 student. Now, so to compute this, you need to have a template. So the template that we have, I will give you the key takeaways, is that you have details here. So here you include what type of payment, what type of benefit are you paying a tax for. Then you'll have computation, so you may need to compute it. Then you'll have the amount that you have computed, and then you'll have the comment. So some benefits, and what I also need to tell you is that employment income is guided by the Income Tax Act under Section 19. So Section 19 clearly specifies which income is taxable and which income is not taxable. So, like we said, so some of the benefits may be taxable and other benefits may not be taxable. So one of the benefits that could be taxable, you may find you are earning salary. So if you're earning salary, the examiner normally gives you a monthly rate. So they can tell you he earns 5 million per month. So it will be 5 million, you multiply by 12 months. If the examiner has examined a question which has an annual, expected to compute the annual tax, but then he has given you rates on a monthly basis. So you multiply by this, then you get the figure which is to be taxed. So this one you have 60 million. And then you come here and say it is taxable. So this one is very important. One, you need to mention how much are you taxing and whether it is taxable or not. Then the other one, you may have let's say medical allowance. Medical allowance. So if they give you medical allowance, now with medical, there are 3 things you need to note here. One is that when they give you medical allowance is taxable. It means that they have given you money and it is paid to you in lump sum. The employer does not ask you whether you have spent the money or not. When you do, you may take the money and you don't fall sick. So you may use the money. So there, the taxman taxes you. So if it is 2 million, it is 2 million times 12, so it will be 24 million. And it is taxable. 24 million, it is taxable. Now, where medical is not taxable is medical insurance. When they give you medical insurance, it wouldn't be taxable. If let's say it is 1 million for five people, so this would be 5 million, and the 5 million. So when it is not taxable, here you put a dash, and you say not taxable. Now, what I'm saying is that medical insurance, here the employer gives you medical cards. You go with them. When you fall sick, you can go to the hospital and you get treatment. So when he has given you medical cards, that is called medical insurance, and it is not taxable. But in the event he has given you what you call medical insurance, that one you tax it. Now, the other scenario where medical is not taxed is if they give you when you go to the hospital, you get treatment, then you come with invoices, and those invoices you get reimbursed. That one is also not taxable. So medical reimbursements are not taxable. Medical reimbursements. So if you spent, let's say 7 million, it wouldn't be taxable. Not taxable. Not taxable. Then the other area which may not be taxable is is per diems. So if you go to the field and then there is per diem, it is not taxable. Per diem of 3 million, you went to Arua for field work and they gave you what you call per diem. It wouldn't be taxable. But if they give you field allowance and you are not providing receipts for it, it would be taxable, or hardship allowance would be taxable. The other area which they normally examine is staff parties. I mean entertainment. Entertainment is taxable. So entertainment is if they give you entertainment allowance, is taxable. The other one is provision of house helps. So the house helps could range from being given a maid, from being given a gardener, or even a driver. They give you a driver. These ones are taxable. These ones are taxable. So the employment income they earn is taxable. But if the employer provides you with a security guard, security guard is not taxable according to practice note of 2001. Wouldn't be taxable, but these ones are taxable. You would include the amounts here and tax them. Now, the other ones I'm going to highlight for you. This is where you need to do computations. Now, there are 3 ways that the examiner asks these ones. One, we have what we call the loan benefit. Loan benefit. So the employer gives you a loan, and then the loan you are paying at a rate below the Bank of Uganda rate, the statutory rate. So if the statutory rate of Bank of Uganda is, let's say, 10%, for you they are giving you a loan at 4%. So this is Bank of Uganda statutory rate. But for you, the employer is giving you at a rate. This is the employer rate. So the taxman is saying this is a benefit and it should be taxed. So the loan benefit is computed by getting the BOU rate minus the employer rate times the loan amount. So it is BOU rate minus the employer rate times the loan amount. So if this is examined, you need to know how to compute it. And what I need to say is that the loan must be in excess of 1 million. If the loan is less than 1 million, it is not taxable. It is considered as a benefit that is not taxable, even if the loan has been given at a lower rate than the BOU rate. So the loan, one of the conditions that the loan must be more than 1 million. So this one would be 10% minus 4%. If the loan given was 10 million, then this would be 6% times the 10 million. So the amount here is the one you would tax. So that is one benefit. So what I also need to tell you is that there are 3 benefits that require computations, and at least 2 of these must appear in the exam according to the history and what has been examined. So you'll find that at least 2 of these will appear. So one of them is loan benefit. So the second one is called motor vehicle benefit. So motor vehicle benefit, the employer gives you a motor vehicle and you can use it for both official work and private work. So the benefit, the loan, I mean the motor vehicle, in that case, it is taxable. So it is considered as a benefit. So how do you compute this motor vehicle benefit? One is that you use a formula, which is 20% times A times B over C minus D. Now, what you need to note here is that these characters A, B, C, and D are defined. Where A, what is A? A is the value of the vehicle, the market value of the vehicle, when it is first provided to the employee for use, for both private and commercial use. Now, so you may find that the employee is, we are computing employment income from 1st January 2025 to 31st December 2025. But then the vehicle was purchased on 1st January 2023. So we needed to depreciate this vehicle from 1st January 2023 to 1st January 2025 and determine what is the carrying value. What is the carrying value of this vehicle for on the first date? It was on the first date we are computing the employment income. So the carrying value on the first date we are computing employment income will be the value of A. And we depreciate the vehicle. We depreciate the vehicle at 35%. At 35% using reducing balance method. That's when we get the value of A. Now, the value of B is the number of days the vehicle is available for use for private and business use. So if the vehicle is available for how many days during the year of income the vehicle was available for private use, that would be the value of B. So these days may be less than 365 days. Then C is the number of days in the year of income. In the year of income. So this one explains, tells you how many days in the year of income. And the number of days in the year of income are normally 365 days. Are normally 365 days. And then D is the employee contribution. The employee contribution. How much is the employee contributing towards the use of this vehicle? So if there is any value that the employee contributes towards the use of this vehicle, it is also considered. So then you get what you call motor vehicle benefit. By substituting in those values, you get the motor vehicle benefit. Now, the next type of benefit is called housing benefit. Housing benefit. Now, housing benefit is a benefit that you compute last. I must repeat this. Housing benefit is a benefit that you compute last, because for it you compute after getting the chargeable income. So, to get the housing benefit, it is the lesser of A or B. It is the lesser of A, the market rent, minus the employee contribution. Minus the employee contribution. So is how much is the rent? How much is the rent in the market? How much is the rent in the market? You minus the payment that is made by the employee for the benefit of the housing. So then you get the answer here. Then B, what is the lesser of, or B, 15% of chargeable income. 15% of chargeable income, the market rent inclusive. Market rent inclusive. So what they mean is you get the chargeable, you first get, to get this, you get the provisional chargeable income. The provisional chargeable income, you add the market rent. You add the market rent, the one you computed above. Then after, you get adjusted chargeable income. You get adjusted chargeable income. After getting the adjusted chargeable income, you multiply by 15%. So the 15% of chargeable income, 15% of chargeable income would be 15% times the answer you got in B, times this answer here. And then the answer you get, you compare it with the one you have in A above. So you compare this and this one, and then the lesser of that becomes the housing benefit. That's why I said you compute it last, because you compute it after you have gotten the chargeable income. So that the three benefits that the examiner normally examines, and like I said, at least two of these must appear in the exam, according to the trend that we have seen in the previous sittings. So after getting the chargeable income, so after getting this, you add it on the template that we had above here. So you add it here under the taxable benefits. So so you add it here. So I'm going to bring it down. So you add what we call so we added the motor vehicle loan benefit. We added loan benefit. So the computation is working 1, and we say it was taxable. We add it there. Then we have what we call motor vehicle benefit. It was working 2. We were saying it is taxable. And then housing benefit. Housing benefit. It is working 3. We add it there, and we are saying it is also taxable. So when you add all the taxable benefits, the one we had above, and then this one, what you get is the employment chargeable income. Employment chargeable income. So this chargeable income, it is the one that you now tax. Okay, so after determining the chargeable income, so you have your chargeable income, which you computed above. Chargeable income, you computed it above. Then you need to determine the tax this employee needs to pay on this chargeable income. So tax is, you have to do a tax template. So you have tax payable. So under the tax payable, now what you need to note is that tax is paid in bands. Employment tax is paid in bands, and we have 5 bands. So we have band 5, band 4, band 3, band 2, and then 1. So you have tax band here. Then you have what we call the computation. So the computation is done for each band, and then the tax payable. So each band will give you the component of tax you need to pay, and at the end of the day, you will aggregate all the taxes. Now, this is tax payable or tax computation. So, and of course, we are computing tax based on the chargeable income. So the tax bands starts from 1, which is 2,820, thousand minus 0 times 0%. So any person whose income is less than 2,820,000 for a year of income, they pay 0 tax. On a monthly basis, it is 235,000. Then you get the answer, this will be 0. The next tax band is 820 to 402 to 4020. So if you have 4,020,000 minus 2,820,000, here the employee pays 10% of the tax. So you determine the figure, you put it here. In the third band, you have, it is between 4,020 and 4,920. So we shall get 4,920,000 minus 4,020,000. And then you multiply by 20%. So this one is paid at 20%. So you get the tax there. The next one is between 120 and 4,920. So it will be 120,000 is 120 million minus 4,920 millions times 30%. So here tax is paid at 20%. Now the extra income which you computed above here, you less this minus 120,000, then times the 40%. So when you add all these incomes, all these taxes, you get what you call the tax payable. And that's how you compute employment income. So the examiner, you have answered him by determining the chargeable income and also determining the tax payable for the employee. Now, the next part I'm going to highlight is the next number, which is called the value added tax. So like I said, value added tax is one of the questions that do not normally miss in an exam, and this one also takes 20 marks. Now, value added tax is governed by the VAT Act. The other taxes we've been looking at, the business income and employment income, are guided by the Income Tax Act. This one is guided by the VAT Act. And it is tax on indirect, it is an indirect tax. It is an indirect tax. The other ones we've looked at, they were direct taxes. This one is an indirect tax, and it is tax that is charged on consumption. If you purchase a soda, you are going to pay VAT on it. So if you do not make a purchase, you do not pay VAT. Now, tax, like I said, is charged on supplies. Is charged on supplies. So we have two types of supplies. We have two types of supplies. We have what we call the taxable supplies. Taxable supplies. Then we have what we call the exempt supplies. Exempt supplies. So the taxable supplies, these are supplies that are taxable. And exempt supplies are supplies that are not taxable. Now, the taxable supplies are of two types. We have the standard rated supplies. Standard rated supplies. Then we also have the zero rated supplies. Zero rated supplies. So the zero rated supplies and the standard supplies are all taxable supplies. Then the exempt supplies, for them, they are exempt. They do not attract tax. Now, what you need to note is that the taxable supplies are supplies whereby a person is required to register for VAT. If someone is dealing in taxable surprise, it means it has a requirement to register for VAT in accordance with Section 7 and Section 8 of the VAT Act. Now, the standard rated surprise are charged VAT at 18%, and the zero rated surprise are charged VAT at 0%. The exempt surprise they do not have an applicable rate of VAT. Now, what you need to note also is that the standard rated surprise are specified. Sorry, the zero rated surprise are specified in the first schedule. Are specified in the first schedule of the VAT Act. So if you want to get the list of the zero rated surprise, you find it in the first schedule of the VAT Act. The exempt surprise are specified in the third schedule. In the third schedule of the VAT Act. Of the VAT Act. Now, what you also need to note is that the standard rated surprise are surprise, for them they are not specified in any. They are not specified in any schedule. Now, if a surprise is not zero rated and is not exempt, then it is standard rated. So for them, they are not specified, but they are neither zero rated surprise nor exempt surprise. That you need to note, because the exam does not tell you which surprise is exempt and which surprise is not exempt. So it does not tell you which surprise is exempt, which surprise is zero rated, and which surprise is standard rated. So it is you now to, with your expertise, to now pick which surprise falls where. So that is the overview of VAT taxable surprise. Now, like I said, as you are computing this number, you need to know which surprise goes in which, because the examiner mixes them. Now, VAT applies or works with two concepts: the concept of sales and the concept of purchases. So the concept of sales, when you sell, you issue invoices to supply to the customers. So you charge them VAT. So the VAT, they pay it to you when they are paying you. And that VAT, we call it output VAT. So it is VAT on sales. It is VAT on exports. Because when you export, you are deemed to have sold. So it is VAT on, it is called output VAT. Now when you purchase, when you make a purchase, people will issue invoice to you and they expect you to pay them. So as you are paying them, they will charge you VAT and you're expected to pay it. And that VAT is called input VAT. It's called input VAT. Now, the purchases, we are saying this one includes the imports. So when you import, you have made a purchase. Then also the purchases themselves and expenses. Now, the examination is focused on this line here. And the taxman is also focused on that area of input VAT. Because you realize that with input VAT, it is you who is in control. Because you are the one who makes purchases. But then sales, you may not have much control. Now, to get the tax payable, to get the VAT tax payable. So tax payable, you can have tax payable or claimable, which is output VAT minus input VAT. So it is output VAT minus input VAT. So in the event that output VAT, when output VAT is greater than input VAT, it means that you received more VAT than you paid out. it means that you have what you call the tax payable, because you received more than you paid out. If input VAT, so if output VAT is less than input VAT, it means you paid more than you received. We call that one VAT claimable. We call it VAT claimable. So you claim, you have money that the government will have to pay you, but there are conditions under which you can receive this claimable. There must be more than 10 million. And when you put in a claimable, it's by practice that URA will issue an audit to you. Now, the output greater than input is payable. So it means you have to pay money to the Uganda Revenue Authority here. Now, why I am giving this is that this is what they expect you to compute. Now, the question is, what falls under input VAT? Because you realize that for you to be in a payable position, you have to have more output than input. Now, for a taxpayer, the taxpayer will want to have more input and less output so that they are paying less tax, or they are in a claimable position. So because of that, it means when you are recording your inputs, you have to be very careful, because you may record what is not claimable. Now, the tax law specifies expenses that are not expenses, purchases, and imports that may not be claimable. We are going to look at those. But before we go there, let's look at the template for VAT computation. Template for VAT computation. Template for VAT computation. So template for VAT computation is divided into two sections. So the first section is the template for output VAT. Template for output VAT. So output VAT, you need to see what is included there. So we say this is VAT on sales and VAT on exports. So you have the details here. You have details, you have computation, details, computation, then you have VAT and comment, and the comment. Now, as you are doing this, we are saying you include the sales you made. So if you made sale of furniture, you are dealing in furniture, you sold furniture, then you pay VAT on it. So it means if you sold furniture of 20 million, it would be 20 million times 18%. Now, there is another concept that you need to master whenever they examine this part. I'm going to put it down here. So the concept is VAT inclusive versus VAT exclusive. So when the examiner may give you amounts, he may say amounts are VAT inclusive. It means the amount he's giving you, in there, there is VAT included. So if the amount is inclusive and is 80 million, it is inclusive. To determine the VAT component, if this is the amount, the VAT component will be 80 million times 18 out of 118. So when you get 80 million times 18 out of 118, you get the component of VAT. The answer you get is the VAT amount. And remember, we are focused on how much is the VAT. Now, when they say it is VAT amounts, VAT exclusive, it means the figure they have given you does not include VAT. So to compute the VAT, you will have 80 million times 18%, and then you get the answer as VAT amount. So that's how you use VAT inclusive and VAT exclusive. So going back to our question, it means that the sale of furniture, if the amount was exclusive, so they normally tell you that sales and exports are VAT exclusive. So you have to check what the examiner said. Then you compute the VAT here, which will be 3.6 million. Then, if it is standard rated, now when you are computing this, you need to put all the answers here. The computation needs to have this. Now, if the amount is VAT standard, then that's when you bring the amount under VAT, and you say it is standard rated. Standard rated. Now, if you have exports, so let's say now you have exports, and you exported the furniture. So if we have exports are VAT exempt. So they are VAT, they are zero rated. The exports are 40 million. So you set 40 million times 0%, because for them they are exempt. So the answer is 0. You come here and say 0 and say 0 rated. So these ones attract marks. So what attracts marks is, what is the comment? Is it 0 rated? Is it standard rated? And then the VAT amount, and then this computation, and then the details. Now you may have the supplies which are exempt. Let's say you have financial services. Financial services are exempt supplies. So financial services of 35 million. So it will be 35 million. You just put here the amount, and you say dash, and you say exempt. This is an exempt supply. So what that means is that you only include VAT when the supply is standard rated at 18%. Then from there you total the VAT, which is 3.6 here. So this, you come here and say this is total output VAT. Total output VAT. Now, what students normally do, they combine input and output and they confuse it. So these ones are two different schedules. Then you come down here and say input VAT. So with input VAT, you say input VAT schedule. So the input VAT schedule, you also have details. You have details, you have computation, and you have VAT and comment. So, like I said, this VAT input VAT is on purchases, it is on expenses, and it is on imports. Is on imports. Now, this is where the examiner needs you to be very, very vigilant here. Let me put it down here. So this is input VAT schedule. So you have details, you have computation, and you have VAT and then the comment. So here we are saying that not all expenses, we are saying it is charged on expenses, it is charged on purchases, and it is charged on imports. And we have said that the examiner may say that this one is VAT inclusive, depending on the question. He may examine and say that sales are VAT inclusive and purchases are VAT exclusive. So depending on where he has put it, you have to dance according to the way he wants you to do. So meaning that here you have the item. So let's say you purchased, if there is purchase of computers, purchase of computers. So computers are not in either schedule, they are not in zero rated surprise, and are also not in exempt surprise, meaning that they are standard rated. So you bought computers of 12 million. So here you will multiply by 18 out of 118. And then the answer you get is the VAT amount. And you say it is standard rated. Or the correct word you would use is claimable. It is claimable. So the cost there is claimable. Because it is either claimable or not claimable. Now, the other one, you may have, now there are some items I'm going to give you that are highly tested and are not, they're highly tested. One is the purchase of passenger automobile. Passenger automobiles. So passenger automobiles, they are mobile, they are executive cars. You buy a Mercedes-Benz for the MD. So if you buy the Mercedes-Benz for the MD, it must be a vehicle which is specifically used for passengers. If you buy a pickup does not fall here. If you buy a truck does not fall here. It has to be a motor vehicle which is used for passenger. You buy a Toyota Harrier, a Mercedes-Benz, a Land Cruiser, and you bought it 200 million. So the VAT you incur here out of 118. So the VAT you incur here, is not claimable. Is not claimable. So you do not include it under the column for VAT. But then you put it under here computation, you bring the value. 200 million times 18 out of 118, you bring the value here and you say it is not claimable. Why they don't claim it is that most times this can be abused by the owners. They buy vehicles for their own use and then they use them in the business. That's why it may not be claimable. Now, the other one is repairs and maintenance. Repairs and maintenance of such automobile. So if you have repairs and maintenance of these automobiles, they are also not, so you may, let's say you incurred 10 million. So it will be 10 million times 18 out of 118. It is also not claimable. Not claimable. Then if there is any expenses of a private nature, or let's say you have entertainment, staff parties, those expenses are also not claimable. Out of 118, it is not claimable. So such expenses are not claimable. If there is any private expenses, they are also not claimable. Now, the other one, which is also normally tested, is the 10%. If you have telephone costs, they are only allowed at the 90% of the telephone costs are not claimable. So 90% is claimable. So it is 90% claimable, which is 10, let's say you have 18 million times 18 out of 118. So this one is claimable. 90% of the cost, so it is 90% times the cost of telephone. But 10% of the telephone cost is not claimable. So if, let's say, this is 4 million, it will be 4 times 18 out of 118. This one is not claimable. So you need to note that. And the other one, which they normally test, is they may put expenses like salaries. So salaries, let's say they paid salaries of 210 million. So it is 210 million times you do not multiply. It is 210, and the comment you put here, it does not have VAT. You say it is out of scope. Salaries are out of scope. So because the examiner, when it is setting, can add salaries there. Now the other one, they normally test is utilities. So utilities like electricity, like water. These ones are, you can say 5 million, then 2 million. These ones are standard rated and they are claimable. 1.8. So you have the amounts here, and you say it is claimable. Claimable. So that the items. Now you add all this VAT that is claimable, and you say this is total input VAT. Total input VAT. So you realize that the input VAT has some restrictions. So you add that, and then you compare it with the output VAT. So you have the VAT payable, stroke claimable, which will be output VAT minus input VAT. So you'll have the output VAT, you raise the input VAT, and if the output VAT is more than the input VAT, you have VAT payable if output is more. But if it is less, then it will be output VAT claimable. So that's how you compute the VAT. So that's all you need to know about VAT. And of course, you need to also master the theoretical areas around VAT. From what we've been saying, the areas which they can examine could come from what we've just talked about. So that is all about the VAT. That is concerning the computation. And now the remaining parts that we need to look at is customs management. And customs management, the capital gains tax, and partnerships and partnership income. These ones, we shall cover them in our next part, episode 2. I thank you for watching this, and thank you for subscribing to Math Abacus. We welcome you for the next sitting to attend what we are teaching here. What we are teaching, this we are giving you in briefs, but when you come to Math Abacus, we offer sessions, and the sessions are detailed. We give the computations and the real-life examples from the question banks. Thank you so much. See you in the next episode.